Towards the end of this series of presentations, we will forecast financial statements over a future horizon for a company. We will then use those forecast financial statements to calculate measures of free cash flow for that firm. To do this competently, we must understand the characteristics of the different financial statements and how they relate to one another. We will now briefly recap on the characteristics of the main financial statements. If you wish to become an expert in financial statements and gain a detailed understanding of accounting information, have a look at our International Financial Reporting course. For the purposes of this topic, we will briefly discuss the balance sheet, otherwise known as the statement of financial position, the income statement, and the statement of cash flows. The balance sheet is a snapshot at a specific point in time of the assets that exist within a business entity and the claims against those assets. The balance sheet must balance. It must balance because the investments that have been made by a business entity must be equal to the finance that has paid for those investments. Generally speaking, there are two sources of finance: equity finance from the owners of the business and debt finance from non-owners. The balance sheet must balance because the investments of a business must equal the total of its equity finance plus its debt finance. Or in accounting terminology, the assets of a company must equal its equity plus its liabilities. The balance sheet outlines on the one hand the investments that have been made by the firm, and on the other hand how those investments have been financed with debt and/or equity. Let's consider the one side of the balance sheet, the investments that have been made by the firm or its assets. The assets section of the balance sheet is split into two categories: current assets and non-current assets. Current assets are short-term in nature, and they tend to comprise of the firm's working capital. Examples may include cash, inventory, and trade receivables. The working capital of a firm tends to fluctuate with its operations, and it tends to fluctuate as part of a cycle. Let's discuss that cycle. The company can purchase inventory from its suppliers with cash or possibly on credit. If it purchases that inventory on credit, a new current liability, a trade payable, will be created. The company must settle this trade payable at a future date by paying cash. Once the company has acquired inventory, it can sell that inventory to its customers. If the sale is a cash sale, the inventory is immediately converted back to cash. If the sale is on credit, a new current asset, a trade receivable, is created. Hopefully the customer pays the company back. When the customer pays the company back at a future date, only then is the trade receivable converted back to cash. And so the cycle goes on. Let's consider the non-current assets section of the balance sheet. Non-current assets are long-term in nature. They tend to reflect the productive capacity of the firm. Examples may include property, plant, and equipment.